So let me talk a bit about how to find high probability TC setups daily. So every day there are many TCE setups that would appear on different currency pairs. And I mean, there are many you could take every day, but I tend to be more selective and I tend to take really high quality TC setups with the highest probability of success. So I'm going to tell you what kinds I look for, what makes it a high probability setup for me. So to summarize, for the TC setups with the highest probability of success, I look for the following things. Number one, I like to ideally ensure that the price is retracing to one of the Fibonacci levels. Again, 38.2%, 61.8%, or 50%. And at the same time, the price is also retracing to a moving average. So again, for a long trade, going long, you want it to retrace to a moving average support level, right? So again, it could be the 6 moving average, the 80 moving average, or the 50 moving average. You want to see it retrace to a moving average. Next, and at the same time, I also want the moving average support for longs to be tested recently to be reliable. Okay, so what do I mean by this? Let me attempt to draw an example, right? So let's talk about going long. When we are going long, we are riding the uptrend, right? So it goes up, this is the impulsive wave, and it retraces down, and it goes up, and it retraces down, okay? So we are looking to enter somewhere here, right? At the end of this retracement wave, we're going to enter here for the next impulsive wave upwards. This is the TC setup, okay? So again, let's go through the points. Number one, price is retracing to a Fibonacci level. So again, what that means is the impulsive wave A, this is A to B, right? So we use the Fibonacci tool, we click A, B, and this level C should be a Fibonacci level. So this should be again a 61.8% retracement, or 50%, or 38.2% retracement. Okay. Now at the same time, I also like to have the C to be at a moving average support. In other words, I also like it to coincide with one of the moving averages. So again, this could be the 18 moving average, or usually it's the 18 or the 50 moving average. Unlikely it's the 6 moving average. Normally it's the 18 or 50 moving average. So what I have here is I have more confidence that this is going to be a strong level of support and reversal, because it is testing both the moving average and a Fibonacci level, right? So we've got a confluence of two support levels. Next, I want to also ensure that the moving average being bounced off in a way has been tested to be reliable recently. In other words, if it's bouncing off the 50 moving average, I like to see that recently the 50 moving average has acted as a strong support recently. Okay, so in other words, if this broke below the 50, then it is not a reliable support as much. Okay, so similarly, if this is bouncing off the 80 moving average, I like to see that recently the 18 moving average was respected as well. It found support at the 18 moving average. It is not a must, but again, these are the best kind of trades to take. Okay. Now, point number 4, I also want to ensure that ideally when I enter my buy, my long somewhere here, okay, the price has not moved too far from the current swing low for a long trade. So again, which is the current swing low? Right, this is the current swing low here, right, at the end of the retracement. Now, I see if the price hits the support and moves too far away, and I'm entering here, I'm a bit late to the party. Does this make sense? I like to enter as close to the support level as possible. As close as possible. Okay, that's what this means. Next, I also want to ensure that the price is not too near the previous swing high. So this is the previous swing high. Right? This is the previous swing high. Or rather, this is, yeah, well, Well, this is actually the current swing high. Sorry, this is the previous swing high. So I would say, yeah, I do not want the price to be too near, sorry, the current swing high. Let me just restate my definition here. Okay, why? Because if the price is already very near the current swing high, sometimes this could act as a resistance. So if you buy too near over here, it may hit and it may not even get 1 or 1.5 R and it could retrace back down. Okay, so the ideal point to enter is somewhere here and to exit at the current swing high or just a bit higher than that, right? To exit there. So this is where we capture rather our 1.5 R or our 2 R of profits, right? And this is so-called the 1 R risk that we're taking. Remember how wave patterns unfold in the markets. So a wave pattern always goes like that, right? It goes up, comes down, goes up, comes down, goes up, and so on and so forth, and repeats the process, right? So again, when we are trading the TCE, okay, we want to capture as much of this area as possible, okay? So to capture as much as possible, we like to enter as close to the start of the new impulsive wave and to exit here before the end of the impulsive wave, before it goes down again. Here. So because of that, we want to ensure when we enter, again, like I said, it's near the current swing low and it's not too near from the current swing high. This is the current swing high. Okay. In fact, if you can take your profits before reaching this current swing high, that's the safest. Because sometimes what happens if the price goes up and it can't break this swing high, it will come back down again, and it becomes what is known as a double top. Of course, if the uptrend continues, it should go higher than that. So, but again, if our profit target is too far above here, we can't reach it and you come back down again. So again, ideally our profit target should be at the current swing high or just slightly above it, but not too far away. And again, that's what I call a high probability setup. So let's look at a few examples here. This one, right? So let's take a look at Aussie New Zealand. This was a trade I took recently, I think about a couple of days ago. And over here, this is the setup, right? You can see, boom. So this was the entry, right? Buy here and then it goes up and you exit somewhere here, if you will, right? So let's take a look. Number one, does the price retrace to a Fibonacci level? Yes. So if you use your Fibonacci tool, that's A to B and C. This is the 38.2% level. So it is a Fibonacci level. Okay. At the same time, notice that the price is also retracing to a moving average support. All right, which happens to be the blue line, which is the 50 moving average. So notice that the 50 moving average acts as a support, right? It bounces off the 50 moving average. And at the same time, you can see that the moving average has been tested to be reliable recently, which is over here. So you can see that this 50 moving average, right? Boom, it was recently tested to be strong. So we want to see a recent test that it has been supportive of the price before. In other words, we know that this currency pair respects the moving average right now. Okay. Next, the price has not moved too far from the current swing low. All right. So this is the current swing low here. So by the time you enter over here, we do not want the price to be too far away. And I know it's a bit subjective, you know. Some people say, okay, what do you mean by too far away, right? Now, too far away has got nothing to do with how many pips. No, it's not about pips. It's about risk to return ratio. So again, I always want to risk 1 to make 1.5. Remember that. Or risk 1 to make 2 ideally. Okay. So I always want to ensure that my 1R, okay, which is the distance from my entry price to my stop loss price, is not too big relative to where I think I'm aiming for, right? 1 to 1.5 or 1 to 2, right? So I'm always measuring it relative to where was the current swing high, if you will. And I'll give you a few more examples in a while, in the next few slides, okay? Next, the price is not too near the previous swing high. Again, it's a bit of a typo. It should be current swing high. And current swing low. And again, I'm referring to this swing high over there. Okay. So when I'm entering here, I want to ensure that the price can move and get me at least 1 or 1.5 R, ideally, before reaching this current swing high. Okay. Okay, so let's look at the Aussie New Zealand chart itself, and again, this is what we're looking for, right? So again, we have a bullish engulfing pattern for the TC setup, all right? So again, you can see that it's bouncing off the 50 moving average, and the 50 was recently tested, okay? And it's also at a Fibonacci level. So again, I want to explain to you how I judge if my risk to return ratio is favorable. So one of the things I do is I would measure. I say, okay, now understand, where do we put the stop loss? We would normally put a stop loss right below the swing low, right? Which in this case would be 0.805, for example, right? 0.805. We round it normally to the nearest pip, okay? Now, if I place my buy order above this engulfing candle, what's going to happen? My entry would be somewhere here, which would be 0.818, for example. Okay, so what's the distance between my entry to my stop loss? 818 minus 805, so that's about 13 pips, right? And again, you can measure using this tool over here, this crosshair. You can roughly measure that this is about, 13 pips. You see 130. 130 means 13 pips. The 0 is the fractional pip, right? So if I enter at 8180, right, and the swing low is at 805, am I going in too far away, right? Has the price moved too far from the swing low? Well, in a way, yes. Why? Why do I say it's a bit far? Because again, the distance is 13 pips. The price has already moved 13 pips away, right? Now, where is the current swing high? That's the current swing high over there, right? That should be my target, where I like to take profit, or slightly higher than that, right? So my profit target would be, for example, 0.82, 0.28. 0.828. We can put it slightly higher at maybe 0.830, somewhere about that, right? Slightly higher, not too much higher, because again, remember that very often, all right, the price would go up, come down, and you'll go up slightly higher and then come down again. So we want to take profit before it comes back down again. Now, it's impossible to predict exactly how high it will go, but again, always be cautious. We do not want to put the profit target too high above the current swing high. So again, at the very most, I'll give, maybe somewhere that 0.832. Again, this takes experience to kind of like guess, how far it's going to go. Okay, so if you look at it, what's my risk to return ratio? All right, so I'm risking this amount, 1R, which is about 13 pips to make 1R. Right, so that's not very favorable in a sense. I'm risking 1 to make 1. I like to risk 1 to make 2, or 1 to 1.5. So in instances like this, you can choose to not take the trade. So you know what, it's not a very good trade to take, I'm not going to take it. Or I still took the trade because I said, you know what, I'm still going to take the trade, but I'm not going to enter at 0818. So in instances like this, what I do is I will place my buy order slightly lower. I'll place my buy order lower. Okay. Now, how much lower? Well, again, this takes experience, but I've mentioned before that I want my stop loss to be at least 8 pips away. All right. So if my stop loss is 0805, my entry price has to be 8 pips above that. So 0805 plus 8 is 0813. There we go. Right. So this will be my entry price. So if my 1R is now 8 pips, then this becomes 1.5 because this becomes 13 pips. Now this now becomes a good trade to take because I'm risking 1 to make 1.5. Does this make sense? Right? So I repeat, if the price has moved too far from the retracement, instead of getting in too high, I'll use a buy limit order. Remember that we use limit orders when we want to buy lower than the current price, right? So I'll put a buy limit order at 0813. But let me just say this, okay? Remember that after the bullish engulfing pattern appears, okay, the next candle must exceed the high of the bullish engulfing candle for it to be a valid setup. In other words, I want to make sure that the next candle goes above the high of the bullish candle before placing my buy limit order at 0813. All right. So let's see what happens in this case. So in this case, the next candle goes up. Can you see that? So the next candle goes above the high. So that tells you, or that tells me that, hey, the price is going to go up. But obviously, I don't want to buy too high. So I'm placing my buy limit order at 813. So the next time it comes down, right, you can see it comes down to my buy order and I'm buying at 813, which is a pretty good price, and then goes boom. And you can see exactly hits the profit target and it comes back down again. So I managed to get 1.5R for this trade, right? So again, you know, if you're a bit confused about this, remember it takes experience. And that's why it's really important to be in our Telegram chat group where we are chatting daily to share with each other our experiences and to, again, help each other to accelerate our learning process, right? But this is how you think as a trader. Always think of risk to return ratio. Is it worth the risk to make the return? Okay, so let's take a look at the short side of the TC setups. Now, similarly, when you're taking short trades, you're going short, again, you want the price to retrace to the Fibonacci level and the price to also retrace to the moving average resistance, and the moving average resistance, in this case, has been tested to be reliable recently. So let's take a look at this example on Euro USD. So you can see over here, we have got the bearish engulfing pattern, right? So we have got our wave pattern like that, something like that, goes up, comes down, goes up, and we've got this bearish engulfing pattern, and we are anticipating the price is going to come down. So we're going to do a short over here. We're going to sell over there and put our stop loss somewhere over there. Okay. So let's take a look. Does it retrace to a Fibonacci level? Yes, it does. Again, if you take this A to B, start of the impulsive wave, end of the impulsive wave, and you can see that the C, which is the retracement level, is a 61.8%. Now you may say, hey, the price went, you know, above that 61.8%. So yeah, but in a way it went above and it closed back below. So it did respect, in a way, the 61.8% level. Next, did it retrace to a moving average? Did it find resistance at a moving average? Yes. In this case, again, it's finding resistance at the 50 moving average. Next, was the moving average tested to be reliable recently? Yes, you can see that it was tested over here, tested here. In fact, it was tested multiple times. So for this currency pair, you can see that obviously the 50 has been respected very much by this currency pair. So that's what we're looking for. Okay. Next, we want to ensure the price has not moved too far from the current swing high for short trades. So again, this is the swing high, all right, and again, the price is going to go down, and this is the current swing low, right? So again, the price is going to go down to that current swing low, exceed it a bit, and then most likely come back up again, right? So again, like I mentioned previously, we want to take as much of this profit as possible. Okay, so we want to ensure that the price has not moved too far from this level and not too near to this level. So we have got again a nice 1 to 1.5 risk to return ratio, right? And again, if the price has moved already too far from the swing high, we could always place a limit order, and hopefully the price will come back slightly to fill us at a higher price, so our 1 hour is smaller, and we can get 1.5 to 2 hour right at the current swing low or just below it. So let's take a look at this example. Okay, so let's look at the charts of Euro USD. And again, this was a setup. You have the bearish engulfing pattern. All right, so you've got your boom, 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 and we anticipate it coming down, right? So we're going to do a short right after the bearish engulfing pattern. So remember that usually what we do is we place a sell, a stop order right below the low of that bearish pattern, right? But again, if you do that, in this case, you find that your entry price would be here, your stop loss would be here. So this is your 1 hour distance. So again, has the price moved too far from the swing high? Again, I always take it in relation to where the swing low is. So this is a swing low, the current swing low, right? So again, you're risking 1 to make 1. You know, so if you put your profit target right at the swing low, you're basically risking 1 to make 1, and so the risk-return ratio is not that favorable. Okay, so again, you can avoid taking this trade if you want, but you know, I took this trade, and the reason I took this trade, I said, okay, if I'm going to enter, I will not enter here because my 1 hour will be too big relative to where it can go. All right, I want to make at least 1 to 1.5 or 1 to 2. Okay, so in cases like that, what do? I would roughly measure and say, okay, where's my stop loss? My stop loss would always be above the swing high. So my stop loss would be at 156.8, for example. All right, and where do I want to enter? So again, I like to enter not too low, right? Oh damn, it ran. Sorry, let me push it back. Where was it? Yes, okay. All right, so remember my stop loss has to be at least 8 pips away, right? At least an 8 pip distance. So if my stop loss is at 1568, my entry has to be 1560 or more, or lower, right? So my entry is going to be there, right? And my profit target would be at the current swing low or slightly lower, right? So in this case, it's 1536, for example. Okay. So now it looks good because now I'm risking about 8 pips, right? I'm risking 8 pips to make 24 pips. Wow, that's 1 to 3, right? I'm risking 1 to make 3, so it looks like a great trade, right? Yes, well, if you can get it, right? But I can tell you through experience, it's less likely that the price would retrace all the way back up and fill me at that level. I mean, if it did, it'd be great, right? But normally from experience, I know that usually if the price retraces, it would normally only retrace 1/3 of the recent candle. So what I'm saying is, if you take this entire candle, this red candle, as 100%, right? 3 out of 3, right? Usually it would only retrace by 1/3, right? So I'm not going to be greedy and place my entry price so high. I'll probably place it somewhere lower, somewhere here, so I can get 1 to 2, and I don't have to go for 1 to 3, right? That's a bit ambitious. I may not get filled. So I could place it, for example, at, let me just do my math. So again, if I'm aiming for 20 pips, yeah. So roughly, if I put it here, somewhere here, I'm risking 10 to make 20. So that's still 1 to 2, that's still pretty good, right? So I'm always judging and say, okay, where's the best place to put it so that I can get filled, but not too greedy, right? So example, I put it at 155.6. Okay, so if I put it there, let's take a look. I'm risking 12 pips to make, okay, so may I put it higher, 155.7. Okay, so if I put it at 155.7, I'm gonna risk 11 pips to make about, yeah, 22. So I can place my profit target somewhere here. So I'm risking 11 pips to make 22, right? 1:2, that's a good risk return ratio. All right. So again, I'm explaining it to you, and so it takes me a bit of time, but on the spot, because of experience, I'm able to calculate all this within a couple of seconds, literally. So the more you practice, the more you can judge, okay, where do I place my entry price, where do I place my stop loss, profit target, do I get 1 to 1.5, 1 to 2, all right? Now again, I'll only place my order only if the price goes below the low of this bearish candle. Because remember, usually we place a sell stop order below the low. That will get triggered only if the price goes below that, right? Normally that's how we do it. But in instances when the price is too far from the retracement level, or so-called the engulfing candle is too big, right, I enter using a limit order, right? So I'll place the order slightly higher in this case. But I want to make sure the price goes below that and then retraces. So let's see what happens in this case. Does it go lower? Boom, yes. So you can see that the price went lower, all right, and then it retraced back and it triggered my sell order at 1.557, all right, and then boom, it hit my profit target. All right, so that's how I basically judge or how I analyze trades and decide whether to take them or not.